Welcome and thank you for joining us today for the Reviewing Asset Allocation. This presentation focuses on plan investment choices and how you can get assistance with creating an appropriate diversified investment mix. Concepts such as asset allocation, risk and return, and types of investment strategies are covered in this presentation. Before we proceed, let me introduce myself. My name is Alfredo Hernandez, a Senior Retirement Education Specialist. Part of any presentation are the disclosure slides. Please take a moment to go over this very important disclosure slide. For those of you that may be audio only, let me summarize as follows. Once again, my name is Alfredo Hernandez, Registered Rep with Voya Financial Partners, and this session is strictly for educational purposes. Here's the roadmap for our presentation. Understanding asset classes, the importance of asset allocation, the core of this presentation, your retirement plan's investment lineup, and choosing your funds. Now, before we begin our presentation, let's go over the retirement funds program. Here is an overview of the structure. We feel it is important for you, the participant, to understand how the program works. And over the last 60 or so years, the program has grown to over 3,800 law firm retirement plans as of December 31st, 2025. Due to the size of the program, the board of directors of the ABA Retirement Funds program can hire some of the best financial professionals. Mercer, serving as the investment fiduciary, the custodian, and the trustee. Voya, full-service record keeper and administration. And Charles Schwab, who oversees/provides, if you will, the self-directed brokerage account. So let's begin. In this section, we will cover asset classes and your investment lineup. It is important to have an understanding, in other words, building a solid foundation with regards to investments. And these are what I like to refer to as the foundation of investments, the three main asset classes. Cash, short-term/stable value for the purpose of your investment lineup, which we will cover later. Examples here are treasury bills and CDs. Bonds, fixed income, or the bond funds that you have access to, once again, via the investment lineup. These bonds can be issued by governments as well as corporations. And most of us are familiar with stocks, equities, stock funds. That can be made up of those large, big brand name companies that we all know, also mid-cap, as well as small company stocks, U.S., international stocks. So let's begin our discussion with the cash equivalent. And again, for the purpose of your investment lineup, this would be the stable value fund. These are short-term liquid investments. Some examples that you may be familiar with are money markets, CDs, as well as treasury bills. But it is important to understand that all investments carry a risk. And for the purpose of cash equivalents, the biggest risk is inflation. Now, when it comes to bonds or fixed income, bonds can be issued by government, corporations, municipalities, as well as international governments, right? Composing of those international bond funds, U.S. bond funds. So it is important to understand the type of fund that you are choosing. Now, when it comes to bonds, the biggest risk, interest rate and credit risk. Interest rate risk. There is an inverse relationship when it comes to interest rates and bond prices. Now, think of a seesaw at the at your local park. What do I mean by a seesaw? On one hand, you have interest rates, and on the other, you have bond prices. And there is an inverse relationship between these two. When interest rates go up, bond prices will decrease. when bond prices decrease, that most likely is due to interest rates rising. That inverse relationship. Interest rates go up, bond prices decrease. Interest rates decrease, bond prices increase. So it is important to understand that inverse relationship. Now, also important, credit risk. Who is issuing those bonds? And will they be there at maturity to pay principal? That is a credit risk that we are taking. For example, what if it's a 30-year bond that you are acquiring? In other words, you're saying, I believe that this institution, government, or corporation will be around for the next 30 years, not only to pay interest or the dividends, but also to be there, say, at maturity, 30 years from now, as an example, to pay back principal. So once again, when it comes to bonds, the two biggest risks, interest rate and credit risk. Equities represent ownership of a company. And as I mentioned earlier, you can have different size of those publicly traded companies, but also geographical. The biggest risk for equities is market risk. We cannot do away with market risk. What do I mean by this? That even good companies, solid companies, in a down market, those good companies can see their stock prices decrease. Market risk, also, it is important to understand, jumping a little bit ahead, but diversification cannot do away with market risk. Now, investment funds, which will cover your investment lineup in just a couple of minutes. What are investment funds? These are portfolios. The pooling of many individuals' monies or savings to acquire multiple, hundreds perhaps, of underlying investments that make up this portfolio that is professionally managed. It's important to note that these investment funds have a specific objective. That's why it is important for you to read the profile page when it comes to the investment lineup to understand the objective of the fund you are interested in. Now, through diversification, the fund may reduce risk. But as I mentioned earlier, keep in mind, all investments carry risk. And when it comes to equities, market risk is present. Types of investment funds. Many of you are familiar with mutual funds. You know that very popular ticker symbol where we can go onto our preferred investment website, for example, and obtain information. Well, that ticker symbol is generated or is available because mutual funds are registered under the 1940 Act. Many mutual funds do have that brand name, that brand recognition. But you also have what are called commingled funds. These are available to institutional clients. They're not listed, say, in your newspaper, or you cannot access the information for a particular commingled fund via your preferred financial website because, well, there is no ticker symbol. They're not registered under the 1940 Act. But there are, benefits. Typically, they carry lower fees compared to those registered mutual funds. The program uses commingled funds. The information available to you for all of the available funds is via the profile pages, which you can access via the plan website. Now, there are two investment styles, and it is truly a debate. The debate stands based on your view of investing. Do you believe that, say, a professional management team can beat the market? If so, then you lean towards actively managed funds, where that particular management team is deploying their strategy with the ultimate goal of beating the market or beating the index. Maybe you feel that, based on your preference or your research, that, it's very difficult to beat the market, even for professional institutional investors. However, you do understand the importance of being in the market. That would be an index fund. Say, for example, S&P 500. Simply follow the market. Follow the market on the way up, follow the market on the way down, and receive the market returns. An index fund will not beat the market because you are in the market. An actively managed fund, the goal is to beat the market, to beat that index. You decide which works best for you. A benefit of funds, is that they do carry lower management fees because it is not being managed in the way of trying to outperform the market. Simply follow the market. So therefore, lower management fees. An actively managed fund compared to an index fund will have higher management fees because it is that strategy that you are paying for. Again, which is best? You decide which is the best investment option for you, or perhaps a combination of both. Now, let's talk about asset allocation, risk and reward, which go hand in hand, and the benefits of the retirement funds program. You are not alone. The tools and resources available there to guide you and help you make the most informed decision when it comes to putting together your investment strategy. Now, asset allocation is the pooling of the various asset classes. In this case, we'll keep it simple, if you will. The three most common: stocks, bonds, cash. Pulling these three asset classes, combining these three asset classes, and creating your portfolio. That is your asset allocation. Now, why is this important? Well, asset allocation is important because this has been tested and tested again. And what the tests have shown is that 92% of the returns can be traced back to your asset allocation. Less than 8% of the returns come from security selection. Someone saying, well, this is a good fund, this is a bad fund, stay away from that fund, for example. Market timing, which is very difficult to do. Market timing is so difficult because you must be right twice. This is the high watermark, let me sell at the high price. And this is the low watermark, let me buy in at the low price. Very difficult to do. Market timing again, because you have to be right twice. And of course, there are other. So again, asset allocation is extremely important because 92% of your returns can be attributed to your asset allocation. And on this part, forgive me for reading this part, but I think it is very important. This is the general summary of one of these tests of asset allocation. But here it is. The lessons of the study was that replacing active investment with simple asset classes work just as well, if not even better, than using professionally managed funds. The conclusion is that the asset allocation will explain over 90% of your portfolio's return. That's why it is important for us to understand asset allocation. If you are too conservative or not taking enough risk, well, maybe you're holding back your portfolio. Well, what if you are too aggressive with your asset allocation? Being too aggressive, you must be ready for the higher volatility. So again, putting the pieces together, the importance of asset allocation, as well as understanding the risk level that you are comfortable taking. Many times in our presentations, we are asked, well, what is the good fund, right? Or maybe hinting as to which may not be the right fund, right? Or the fund that I should stay away from. Well, it's not so much a good fund versus a bad fund because you have a tremendous investment lineup that we will cover in just a moment. But I think focusing on these two slides that we just covered in this presentation, I think the more appropriate question is, what is the appropriate asset allocation for you? Combining also the risk level that you are comfortable with when putting together your asset allocation. The good news is that you have a great investment lineup, but also tools and resources to assist you, whether it's a quick way to select a fund that gives you an asset allocation or putting together your asset allocation. Now, you can go at it alone and create your own portfolio from the investment lineup that we will cover. Or you can use the tools and resources available to you to craft, once again, the appropriate asset allocation for you. One quick way of crafting the appropriate asset allocation are the target date funds that we will cover, as well as the risk-based funds. Or you can use, as I mentioned, those tools and resources, the advisory services, to craft your asset allocation. Now, let's take a look at the investment lineup, which I mentioned earlier, and it's simply my opinion that I think it is a tremendous investment lineup because it is truly aiming to cater to every investor need, but also with the idea in mind of providing you with options to have a fully diversified portfolio, having the importance of asset allocation in mind. Now, path one, it's that quick and easy approach. Path two, maybe I'd like to go at it alone and craft my own portfolio. Or path three, I'm retired or nearing retirement, so let me craft that fully diversified portfolio for someone in my category, say approaching or in retirement. So let's take a look at your investment lineup. Path one, it's that quick and easy approach, and there's nothing wrong with this approach of selecting one fund that will provide you with immediate diversification, that it is investing based on your age and time to retirement. That would be the retirement date funds. What we do is use age 65 as a general retirement age simply to provide you with that set point in time to say, okay, if I were to retire at age 65, whether I'm 25 years old or 55 years old now, which target date fund would I choose? Will you choose one closest to the year that you would turn 65? And next, the portfolio is walking alongside of you. And as you get closer and closer to that retirement year, the target date fund, target retirement year, target date fund, slowly every year is reallocating. And to generalize it, sell from the stock portion, put a little bit more in bonds, put a little bit more in cash, therefore becoming ever so slowly more conservative, walking alongside of you towards your retirement date. And then merging into the post-retirement date fund, a conservative strategy. Please refer to the profile page via the plan website to view the asset allocation, the makeup, the breakdown of the target date fund that you may be in or considering. Now, you also have the target risk funds. Similar approach, right? Asset allocation in mind. But here's the importance of the target risk funds, is that it is up to you over time to make the change. Let's say, for example, that you're 30 years old. You want to keep things simple. You want a fully diversified portfolio. But because time is on your side, you're willing to take on higher risk. So you select the aggressive risk fund. Now, years later, maybe you're mid-career, and you said, it's time to start decreasing that risk. And I will move from the aggressive risk fund into the moderate risk fund. And then maybe 5 years to retirement, or you're approaching retirement and you said, it is time to start being a little bit less risky. and let me move from the moderate risk fund into the conservative risk fund. So once again, path one provides you with, by choosing one fund, whether it's a retirement date or a target risk fund, immediate diversification, right, which is key, a fully diversified portfolio. But what's important is that the retirement date fund will, on its own, become more conservative over time until it merges into the post-retirement date fund. Whereas the target risk fund, it is up to you to make that change over time. As I walked you through that example of, I started in the aggressive risk fund, later on I moved into the moderate risk fund, now I'm approaching retirement or in retirement, and I am in the conservative risk fund. You decide which works best for you. Path two, here you see the importance of the investment lineup and the benefit to you participating in the retirement funds program. You have both index as well as actively managed funds to choose from. What Mercer does is go out into the marketplace and say, for example, looking at the actively managed fund, the small mid-cap equity fund, that is your actively managed fund. Mercer does all the due diligence, does all of the work, and selects individual fund managers to make up the small mid-cap equity fund. So each of these sub-advisors, as you may see them listed via the profile page, those are the investment firms managing this one single fund, which is way different than simply having a mutual fund from XYZ fund company, one manager, one team, right? Here, multiple strategies that make up one actively managed fund. And of course, you also have the index funds, right? And as I mentioned, Mercer does all the due diligence. If there is ever a need to replace a fund manager, well, Mercer will make that recommendation to the board, and the board makes a decision. But you see that you have in path two all of the major asset classes covered. U.S. equity funds, international funds, stock funds. You have your two bond funds to choose from, active as well as index. And there it is, the most conservative option, your cash position, if you will, as we covered the asset classes, stable asset return fund. Then two diversifying funds, the alternative alpha fund. Keep in mind that you can have no more than 15% of your overall balance in the alpha fund. That is a hedge fund. And you also have the real asset return fund. Once again, the idea behind the investment lineup, you can choose path one, diversified portfolio. Path two, let me create my own portfolio, but a fully diversified portfolio from the major asset classes. Path three, I'm approaching retirement, I'm in retirement, but I need to have a fully diversified portfolio, investment choices to consider. Now, maybe you are looking for additional options. Enter the self-directed brokerage account. Here you have access to the universe of mutual funds, individual stocks, bonds. Take a look at the underlying offerings. It is a great investment choice for the experienced investor if you are looking for additional options. So please take a look and see what works best for you. Now, as I mentioned earlier, one of the benefits of the retirement funds program is that you are not alone, and it is built to truly cater to every investor need. We went over the investment lineup, plenty of investment options, including the brokerage account if that is something that you are interested, but also great tools and resources. One of these is the My Orange Money experience. This is Voya's answer to the question of, how much do I need to retire? Or perhaps, I'm looking at this balance and what does this mean? This is an interactive experience that you can access via the plan website as well as the app. And what it does is gives you a better answer to that all-important question. I'm staring on my balance. What does it mean based on today and my projected retirement year? We factor inflation into the equation here. So what we're doing is doing that, generating that future forecast, if you will, and bringing it into today's dollars. So that when you look at the numbers on top of the My Orange money bill, what you're looking at, that middle number there, is your projected retirement income goal, or what I like to refer to as your projected monthly retirement bills. We start that conversation by using 70% of your current earnings because financial planners recommend that we need to replace anywhere between 70 to 85% of our current income for each year in retirement if we would like to maintain our current lifestyle. So we begin the conversation with 70% of your current earnings. Simply, again, to start the conversation, give you a goal. But of course, you can make the adjustment. And then the My Orange Money experience, the orange dollars, on the upper left-hand side of the orange bill, that is your projected monthly retirement income. So again, we do that future projection, but bring it into today's dollars so that whether you're 25 or 55, you can say, well, if I was 67 this year, based on the screenshot in here that we're sharing, if I were 67 this year, retiring this year, you're telling me that my projected monthly bills would be $4,300 and change, yet my projected monthly income, which by default is my retirement funds program balance, along with Social Security benefits, which is simply an estimate based on your age. In this example, you're telling me that my projected monthly retirement income would be $3,800 and change, and therefore not meeting my retirement income need by about $500 a month. So you see, this is a better way, in my view, of answering that question. I'm looking at my balance. What does this mean? Okay. And then from there, you can, of course, make adjustments as needed. Maybe you do need to consider increasing your contributions. Maybe you have other retirement income sources that we are not aware of. So maybe you can include those in the calculation. Or maybe you're in the process of rolling over that prior 401k plan. If that is the case, or you need assistance, give us a call. Our team can assist. But as I mentioned, maybe you're in the process of rolling over that old retirement account that you have from a prior employer, and once it's here, it'll be accounted for. Okay, so please take a look at the My Orange Money experience. It is a great resource. You can also take a look, right, at the advisory services that are available. Because as I mentioned, the retirement funds program is catered to every investor need. Some individuals may want to keep it simple, and nothing wrong with that, right? A great mix, not a suggestion, not a recommendation, but just a great mix is, say, choosing a fund from option one, whether it's your target date fund or your target risk fund. That is doing the investing for you. And the My Orange Money experience is doing the translating for you. But maybe you need something more precise. You need to create your personalized retirement strategy. Enter the advisory services. These advisory services are offered through Voya Retirement Advisors and are powered by Edelman Financial Engines. And you have two options. For those of you that say, give me what the plan offers, I can go at it alone, but I do need assistance. I need tools and resources. The online advice piece, as you see on the left-hand side, this is giving you access to the Edelman Financial Engine software. Or maybe you said, I do need help. Maybe my plate is full. I could do this on my own, but I just don't have the time or patience. Then consider professional management, which is a fee-based program that's working with our Voya Retirement Advisors. But first, do it myself, right? And I would recommend, please go on the plan website. Take a look at the online advice piece, especially if you're looking at crafting your personalized retirement strategy. What do I mean by this? Well, maybe you do have that dollar amount in mind, but you also have a time to retire. For example, you want that $1 million account. You want to retire, say, at age 62, right? And what Edelman Financial Engines does is answer that initial question. From today, can I get there? Yes or no? But the great part, as you see on the screen, is getting a side-by-side comparison. My current strategy. Will my current strategy get me there? What if the answer is yes? Fantastic. That's what you were looking for. No need to make changes. But what if there is a better strategy? And that's what Element Financial Engines will show on that comparison. Current to recommended strategy. Keep in mind that the portfolios that are being built, these portfolios are from your investment lineup. We are not selling you outside funds. So use Element Financial Engines, the online advice piece, to maybe just get a better understanding of your portfolio or help you put together that asset allocation. Again, you are not alone. And then follow the steps if you said, wow, look, this recommended strategy actually is in fact much better based on the projections than my current strategy. Well, maybe I do want to put that strategy into play. We'll just follow the steps to craft that strategy. Or you would like to explore professional management. Keep in mind that you have a free consultation. Give our team a call, and I would recommend that. Have a conversation with one of our Voya retirement advisors so they can explain how the program works. Also, the cost to you. And of course, if you said, that sounds great, you're doing the work for me, and 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 the price for this program is reasonable, let's go ahead and sign up. Or maybe you said, well, thank you for the information, but not at this time. I'm not ready to sign up. Great. You walk away with additional information. You walk away with a better understanding of not just your account and your portfolio, but also the options that are available. So again, please explore this option. And again, keep in mind that you do have a free consultation. You can reach us. You see the number on the screen there. Give us a call, have a chat with one of our team members, and then you decide what works best for you. But also, as we approach retirement, whether you are using the online advice piece or you are enrolled in professional management, income beyond retirement. Okay, it's prepping your account for retirement, for that distribution phase. So look at all these great tools and resources that you have. For some of you, the My Orange Money experience may be suitable, maybe at this time, and maybe things change later, or maybe that is the right tool to help you get the job done. Some of you may look towards the advisory service, maybe the online advice piece, right? Because you can go at it alone and you're comfortable with these great tools and resources. Or maybe you do see the value of enrolling in professional management. So please, again, explore your options. And I think it starts by giving us a call and having a conversation with one of our Voya Retirement Advisor team members. Choosing your funds to consider, whether it's on your own or putting all the pieces together and using the tools and resources from left to right. Yes, I believe that it starts with risk, truly assessing your risk level. How much risk am I comfortable with in putting all the pieces together, right? Again, it's not so much which is the good fund, which is the bad fund to avoid. No, it's putting these pieces together and crafting your strategy. But in my opinion, it starts with your risk level, truly understanding how much risk you are comfortable with when it comes to your portfolio. And then moving into your time horizon. Because investing 101, the more time you have the more time you have to your retirement date, the riskier you can be with your investment choices today. Life events. As things change, maybe that does call for a change to your strategy, or maybe it does not. Simply stay the course, right? But do consider these life events that, again, I say maybe it requires a change to your strategy, but just simply having a life event, maybe that doesn't necessarily mean that you have to alter your strategy. And of course, your situation, right? Maybe your marital status as things change, as the family grows, and you have other expenses, right? Maybe your strategy may need to be tweaked. So know that this is not set in stone, and you have the tools and resources to assist you to help you see those projected numbers. Well, if I were to do this, right, what would that mean to me? So please use all of the resources available to you via the retirement funds program. And here are a sample of asset allocations, right? An aggressive portfolio. This is about 90% stock, 10% bonds, as you see here. US stock, small cap stocks, international stock, and a small portion of bonds. Maybe in there you could even throw a little bit of stable value, right? Your cash component. But as you see, time progressing, getting closer to retirement, well, now maybe I should be in an aggressive portfolio. But then later on, I need to start making those adjustments. And here you see that my bond portfolio increases a bit. Enter, right? Maybe my stable value now at a higher percentage here, but I still have quite a bit invested in stock, US, international, small, mid cap stocks. And now approaching retirement or in retirement, a conservative strategy, not a safety fund, not a cash fund, but you see here a conservative strategy that, yes, now it has a higher percentage in, say, stable value, if you are creating your own portfolio, right? A higher percentage in bonds, fixed income, right? But look, you still have a good amount invested in stock, primarily US stock. So these are just sample asset allocations to get the conversation started, to start thinking about, let me compare that to my portfolio, right? Where do I stand? But I think that the best comparison would be using Edelman financial engines, either the Edelman advice piece, or as I mentioned, I recommend make the call, have a chat with one of our advisors. So make the most of the plan. And at least once a year, review your portfolio. Set a goal. Make sure that your goal aligns with your portfolio. Understand risk and return. Again, aligning that with your goals. Maybe your goals require a higher retirement income. And in order to achieve that, maybe you need to put those pieces together. Well, maybe I need to contribute more, and I need to ensure that I'm taking enough risk so that I can achieve that goal. And a great way to answer that question is using the advisory services. And if you are doing this on your own, again, just once a year is more than enough. Review your portfolio. If you are enrolled in professional management, give our team a call. Have that conversation with them, right? So here's the contact information. Please visit the plan website, abaretirement.com. Give us a call if you need assistance. Our team is available Monday through Friday, 8 a.m. to 8 p.m. Eastern Time. But also, as I mentioned, explore the advisory services. Remember that you do have a free consultation. If anything, you can walk away with additional information after chatting with one of our team members from professional management. Get a better understanding of what the program may do for you. And if you are already enrolled in professional management and it's been some time since you gave us a call, please reach out, right? Part of your review process. Download the app to conveniently manage your account. And also, our customer service team is available if you need assistance. Give us a call, 800-348-2272. So I want to thank you for your time. Please review this important disclosure slide. And once again, give us a call if we can be of assistance. It's been my pleasure. I hope that you find this session informative. And once again, if we can be of assistance, give our team a call Monday through Friday at 8 a.m. to 8 p.m. Eastern Time, and ask to be transferred over to the advice team to have that conversation with one of our team members. Thank you very much. Have a great rest of your day and take care.